Okay, hello everyone. My name is Vikas Agrawal. I am the founder of AIF and PMS Experts India. We are one of the largest platform for investing in alternate investment funds and portfolio management services. As you might be aware that we keep organizing these shows, which we call it Ask the Expert Show. And the idea behind running this show is to educate and empower investor community as a whole, and therefore we keep inviting industry experts. So with me I have Mr. Kunal.
Hi Vikas, thanks for
Hi.
having me.
So firstly, Kunal, thank you so much for accepting our request and agreeing
Most
to
welcome.
do this show for our investors. There are a lot of them, they keep appreciating our work, so thank you
No,
so
you're
much.
doing excellent work.
Yeah, thank you. So Kunal, what I'll do is, the format of the show is very simple. What we do is we first try and understand how do you invest money, how do you select stocks as a portfolio manager, and then we talk about the outlook of the equity markets. Like, there are investors who have invested, they wish to know more about
Sure.
what's your house views on the markets basically. So let me start with that. Let me just introduce Kunal. So Kunal brings about almost 2 decades of rich experience when it comes to equity investing. He spent 15 years on both listed side and unlisted space as well. He has worked with large private equity firms as well, and he's a CFA holder and studied from I am Ahmedabad as well. Right?
Bangalore,
I
yeah.
am Bangalore. I'm sorry. Yeah. So Kunal, first of all, we just want to know your journey. Your journey, as in you started up your own organization
Sure.
as an entrepreneur, and that was in Pune, I believe. And
Yes.
then you decided to go on the other side of the table and started working with these large conglomerates who are maybe managing billions of dollar of asset under management under the advisory side of real estate private equity. So over to you.
Yeah, so after I completed my MBA from IIM Bangalore, I joined Hindustan Lever as a management trainee and soon was responsible for sales for Hindustan Lever in West UP and Rajasthan.
Right.
That's when I saw that supermarkets and hypermarkets were gaining traction, in North India, and we didn't have similar kind of chains in Bombay side.
Right.
And that's when I felt there was an opportunity to build a hypermarket slash supermarket kind of concept in West India as well. We chose Pune as a location because that's where we had some land and we could build on it. We chose to own the property rather than rent, so that our outgoes on a monthly basis were minimum. So I ran that hypermarket for 3-4 years. During this time, I saw that there was a massive asset boom across real estate, equities, even
Right.
gold during that time. Our land and property was valued many times higher than what we had bought it at. And then when we looked at the opportunity cost of running a hypermarket, we felt it was better to exit the property and focus on creating wealth by investing.
Sure.
That's how I got to know that investing is a very, very lucrative way of building long-term capital. I shifted to trying to invest into private companies through private equity initially, and from then I graduated to public markets.
Right. So you are a portfolio manager for Lapis.
Yes.
Can you talk to our investor and tell them more about your organization, the background, the DNA or the ethos
Absolutely.
of the organization?
Absolutely. Lapis was set up in 2016 by a senior management team of Sun Apollo. Apollo is the US private equity fund. In 2016, we took over the business of Sun Apollo into Lapis. Lapis has 2 businesses. The first business is real estate private equity, where we advise over $2 billion of capital. Here the capital is from global institutional investors that are looking to make investments in real estate in India. The second business that Lapis has is the portfolio management services business, where we got registered with SEBI in 2019. And I am looking after that part of the
Right.
business.
So can you talk to us about your team? How big is the team and what kind of expertise your team of analysts bring on the table?
Sure. So our team size at Lapis is about 15 people. 10 are on the private equity side and 5 are on the public market side. Of course, there are a few shared resources in finance, legal, compliance. That's the setup that we have.
Sure. Okay. So, what we wanted to know is basically two things. So, as I said, we'll talk about the outlook of the markets. There are investors.
Sure.
If you look at in last 18 months, they're not able to make money.
Yep.
They're really concerned, and they're now comparing their mutual fund investment returns vis-a-vis PMS returns. And obviously, because in PMS you have a concentrated portfolio, they're not their returns have beaten down more than mutual funds.
Sure.
So that's the concern which is coming up. So just wanted to know your views on that.
Yeah, so I think that depending on the strategy that you are invested in, you would take a different view on how performance is being measured. So we have only one strategy, which is a compounder strategy, where we're investing in the best quality businesses. So in that strategy, if you find portfolios down, what you would look at then is the fundamental earnings and cash flow of the business. So over the last 18-month period, where I feel the market may have time corrected, has those fundamentals and balance sheets improved? So for a 20% compounder, they should have improved by, let's say, 30%. And if a portfolio is down, let's say 5-7%, then really that you are in a much better position today than where you were 18 months back in terms of a valuation perspective. I would only start getting worried about the portfolio if we are unclear about the fundamentals or the long-term sustainable growth of earnings and cash flows of the businesses that the portfolio hold.
And that is where you get worried. Otherwise, you clear that you.
Otherwise, when you are invested in the best companies where we are seeing growth happening, we are not worried at all.
Right. So you said it's a name of the strategy is compounding strategy, right? So where this name come from? It's the eighth wonder of the world,
Absolutely.
And I keep telling my investors that if your portfolio is growing at 15%, we are talking about 16 times in 30 years time.
Right.
So knowing the fact that compounding is something which very few investors really understand, to my mind. But everybody talks about it.
Right.
So how do you see compounding?
Absolutely. So compounding in my mind is clearly the eighth wonder of the world. It all boils down to how you view the value of a business. We believe that the value of a business is a function of their sustainable earnings. So if sustainable earnings are growing, the value of the business is growing. In compounders, what's happening is that we are compounding sustainable earnings over time. So therefore, that leads to a compounding of value over time, which then leads to return for the investor. We believe that compounding has a virtuous cycle where you make an investment, you get a return on capital, that capital is then reinvested in the business to again grow sustainable earnings. So compounding in our view is the best way to make long-term wealth creation. There are many ways of making money in the market, but they are mainly short-term in nature and opportunities where you can't put much capital. And therefore we believe compounding is the right way to make long-term wealth.
Right. Makes sense. So just wanted to read your mind. You have a sort of framework in place, or you're flexible and you're open to look at some momentum stocks also, or maybe ready to chase some cyclical changes in the...
Not at all. I think we are sticking to the compounder strategy. We have a bottom-up fundamental approach to picking stocks. We are looking at very strong competitive advantage, long runway for growth, high ROCE, low debt, and management with a track record of execution and corporate governance. So these are the things that we are looking at when we try and build the portfolio. When we have screened the market, we find that there are about 80 to 100 business that meet our screeners.
Out of 6,000 stocks.
Out of 6,000 stocks, consistently. So
you put
our
really
portfolio,
a very strong asset test before these?
Yeah, I think it's better to put a strong asset test. Would you like me to own the 81st idea in my portfolio? No. No. And I actually want to concentrate as much as I can. Yes, because of risk management, we do diversify and we have a portfolio of around 20 stocks. But that I think is sufficient to manage diversification risk.
So two questions quickly on this particular philosophy. One is, we saw for the first time that these quality names in the markets have beaten down the most. I mean, generally doesn't happen. Like if you look at last decade data or 2 decades of data, they've been consistently growing at 15% to 18% depending upon what. So what's your take on that? Like some of the businesses are at all-time low and they're all good quality names and their earnings are also growing.
Yeah, so I think that when you marry the earnings cash flows with the stock prices, what you see is actually an opportunity to invest more into those businesses. For certain reasons, whether cyclical commodity sectors have done well recently, that is actually given an opportunity investing in some of these high quality names that earlier were at valuations where you would find it difficult to bring them into your portfolio. Today at the current valuations, I think actually there is a good opportunity to bring these into your portfolio, and you must. As we know with commodities and cyclical sectors, they are cyclical. And if the cycle is up now, that's not where you should be putting your savings.
So you believe in doing clean work, identifying high quality businesses, and you're not really looking at price at all when you've invested in them?
I think price is a factor. Certainly when we say that we've screened and we've come up with 80 to 100 stocks, which is dynamic, but 80 to 100 stocks on average, price is the determinant on what we see in terms of what is the upside and downside of each stock that is entering the portfolio, what is the probability weight against that upside and downside, and that's how the portfolio gets created. Right. It is not a portfolio of the top 20 businesses in India or the top 20 quality businesses in India. It is a subset of the 80 top businesses in India, depending on risk and reward.
Right. So, Kunal, there are two lobbies. One lobby says that, look, concentration is the best way to create wealth, make a concentrated portfolio. Now 15-20 depending upon the fund manager. There are fund managers who say that these are just numbers. Whether you buy 15 stocks or 20 stocks, you need to look at what is the CAGR that you are making. Which lobby that you feel prefer to join?
No, I certainly feel that it's much better to have a concentrated portfolio. I think that selecting 20 top ideas is easier than having 80 ideas in the portfolio. I want my capital to be behind my best ideas. It's the simple fact. I would even advocate an even more concentrated portfolio with someone who's willing to take a little bit more risk and a little bit risk on the diversification side. But yes, concentration is something where I believe completely, because if you're 20 ideas, you don't have 80 ideas that are making 20% return. You most certainly could have 15 to 20 ideas that are doing that. And that's why I feel that concentration is very important.
Right. And one of the things which I want to highlight for our investor is, see, look, when you are investing in concentrated portfolio, one thing you need to understand is that it will not behave like a over-diversified portfolio. When you are taking concentrated bet, obviously, you will see more downturn during the bad times. And that is where you need to be mentally strong to stay put, and rather, as Kunal rightly said, that is the time you should accumulate more. You
Absolutely.
should put more money to it.
Absolutely. The only reason that people don't put more money at the right time is because they're unsure of the quality of the businesses they've invested in.
Right.
They are worried that, listen, I'm not so sure about earnings, fundamentals, whether this company will blow up, whether this company will degrow. Those are the thoughts that come in when they look at portfolios.
Right.
But on a compounding basis, when you look at any of the portfolio constituents that we have in our portfolio, you would be very comfortable and sleep well at night putting more capital to work.
So who is Kunal? Value investor or a growth investor or a contrarian or believe in God?
Yeah, I think I'm a growth investor. I think the Indian market supports that. We have many businesses that are growing 15-20%, and one should capitalize on that opportunity to grow your portfolio. There are many places across the world where the growth is not that strong, and their value, other things could be better ideas.
Right.
For me, I'm looking to capitalize on the growth what our Indian market is offering us.
But do you think that growth at a reasonable price is a good option?
Growth at a reasonable price is always the best option. Nobody wants to overpay for something, because that only ends up compromising your returns that you would make. So certainly valuation is something that we keep in mind. That's why we have our universe of 80 to 100, and we're trying to figure out where we're getting the right value and the right upside for the risk that we're taking.
So Kunal, the space where you operate, in that space, when you look at these quality businesses, that's my observation, they always demand premium. You will not find them at a lower valuations. Well, this is in your mind that, how much you really want to pay. So what should be the right way to look at these?
I think there is the most clean way to look at this is on a discounted cash flow basis. Of course, so we do it, but we don't hang our hats on it, because small changes in variables in DCFs have big impacts on outcome. But that's certainly a check that one should do. Some sort of ranking in terms of what you feel is the best quality business in terms of growth, ROC, management, structural story. That's what we do. We kind of rank these companies from 1 to 80 on quality parameters, and then have a basis of what we're willing to pay more for, what we're willing to pay less for. These quality businesses are optically expensive, but when you look at a longer term time frame, you will find that the returns that are coming and the fundamental improvements in the business that are there over a 5-10 year period more than make up for the initial, say, 20% premium that you're paying for them.
Yeah. So Kunal, which side you are in? You're believe in active investing or passive? If active, within active, you believe, when do you book profits, and when do you really come out of the stocks? When do you exit the stock?
Sure. Obviously, we are very firm believers in the active management. We don't want to follow an index blindly without knowing the underlying constituents, regardless of the weight of the underlying constituents. We have many businesses in our own indices where they have outsized weights in the index. So we would definitely not be a passive investor. It is a strategy that also works, but we are active investors, and we think that if you can be sensible about which businesses you choose, you should be able to outperform the index over the long term. There are businesses that have grown very big and are part of the index. If you itself look at the index constituents on a multi-decade basis, they're not the same, and that's because these businesses fade away, or other businesses have grown or are more exciting and have done better that enter the index. So on a long-term basis, actually we see that many of these underlying businesses fade. So we should be actually active in terms of identifying the new waves to stay ahead of the index.
So then when do you exit the stock?
Yeah, so we exit the stock, and usually there are only two reasons to exit the stock. One is if we have a much better idea that's come up either because of price action or because of something changing in the fundamentals that we are liking. So one is we have a better idea to invest in, and two is when the thesis is not playing out as expected. We try and cut our positions when the thesis is not working out pretty early.
Okay. So you keep evaluating at the regular
Absolutely.
interval. Okay. And do you believe in booking the profits when you see valuations going up?
Yeah, I think that one should book profits when valuations are stretched. We don't consider 5-10% extra to being a stretch. So if my best idea in the portfolio is not at fair value but at 5-10% higher than fair value, we may let it ride. But certainly when it starts getting excess, we should cut positions.
Right. So what is the kind of returns one can expect? Well, of course, returns are a function of the markets, depending upon where the markets are headed. But given the fact that we are, say I'm your investor investing and giving a mandate to you to invest on my behalf, what is the kind of time frame you look at, and what is the kind of return that I should expect from you as an investor?
Yeah, so I think that the strategy of compounding has delivered 15 to 20% historically.
The earnings or the returns?
The returns and earnings, if you look at a long period of time. Recently, yes, earnings have been at 15-20%, but returns have been lower. But if you look at 10, 15, 20 years on this kind of a strategy, you would find that returns are in the 15-20%. I think that it's difficult to predict the future, but surely if somebody has a 15 to 20% of target in mind, it's not out of whack. And I don't want to say that one should expect it or target it, but that's a reasonable outcome given that's what we expect earnings to grow at.
Right. Now, Kunal, what is happening is particularly in PMS industry, when you look at these concentrated bets that you take, obviously it goes through its own difficult time, and whereas at times there are investors who are really emotionally attached to this, and like 18 months or 20 months are over and they're not able to make money, they're sort of going out of the strategies, and either they're switching to the another asset class, or they're sort of booking the losses. What would be your advice to them?
Yeah, my advice would be to certainly stay put and even consider allocating more. It isn't often that you see fundamentals going up but stock prices lagging, and those are the times that's actually the opportunities to invest in these compounder kind of businesses. So that would be my advice. Second, I would urge them to all look at the underlying portfolios that they have and be convinced that actually the fundamentals have improved significantly, and therefore it wouldn't make sense actually to be exiting at a moment like this.
Right. But you know, these investors, so they've been investing in mutual funds also and other instruments.
Yeah.
And obviously when they see that mutual funds have sort of maybe at par with PMS perhaps,
Right.
or maybe with other instruments, but because of the fact that it is a concentrated portfolio, sometimes the impact is maybe 1 or 2% higher than mutual funds, because that's over diversified portfolio, right? So what would be your I mean, if you are the investor, you would like to add more money into the portfolio at this point of time, looking at next 6 months, 1 year?
Absolutely. I think that valuations currently for many businesses are quite favorable compared to where they've been in the past. I also feel that many of the cyclical sectors where these strategies are not playing have played out. Right. And there is not much more upside in those cyclical sectors, and therefore this strategy should perform much better going forward.
Right. So Kunal, last few questions, and coming back to markets now. So what's your house views on markets? Where are we right now, and where do you see 3 years, 5 years down the line?
Yeah, I'm pretty confident that 3 years, 5 years down the line, we'd be back on a growth trajectory, and the long-term market returns should be restored. There is some fear currently in the market that whether Indian economy will grow at the same rate given interest rates are up, disposable incomes are getting hit, and maybe there is some amount of growth slowing that we would see over the next 12 months. However, I think that valuations now have factored that in. We have seen valuations not move, we have seen prices not move for 18 months now.
Yeah, it's a time correction.
So we've seen a good time correction, and therefore valuations are looking much more reasonable than where they were. And I would be very comfortable to be making the investments at this time.
Okay. And globally, where do you see India? How are we emerging as, like, the people talking about we becoming the third largest economy in the world 5 years down the line, because you have Germany and Japan which is degrowing and we are growing, so obviously we're going to be $5 trillion. Do you see that is happening?
Yes, I think that is most certainly happening. That is mathematics. If we grow at in the mid single digits, we should be the third largest soon. I don't know which year that will be, but that is mathematically going to happen. Second, I think that we are amongst the few countries in the world where we are seeing growth plus some degree of safety in terms of we are a free market, we don't have unreasonable taxation structures, we are friendly for investors. I think that a lot of those things matter, and we're seeing India emerge quite positively there. So marrying that with the growth, I think that we are a great destination for foreign investors.
But at the same time, Kunal, we saw that more than $50 billion of assets these FIs have sold and went away. And we don't see any sign they coming back to India at this point of time.
Yeah, we didn't see the sign when they were leaving either. So, you won't get those kind of signals, but they will happen.
Yeah.
Of course, interest rates across the world have increased, and now there is a new asset class where you can potentially also make some return. And therefore, there is some flight to non-equity asset class as well. But having said that, I think that we will see return of FPI money. We will see FIIs coming back. There is no option but to look at India very favorably from a growth perspective. I don't think that other economies are growing or maybe hold a candle to India from that perspective.
Right. So maybe last question, Kunal, from my end. What are the 2-3 concerns you see going ahead next 3 years, 5 years as an economy? Where do you think we can go wrong?
As an economy, I think that we are on a comfortable path. I don't think that we are making any big decisions from a regulation perspective to hamper that in any way. I think that from an interest rate regime, we are probably going to see the peak this year. And therefore, I don't see much more risk on the interest rate side. I think inflation is already peaking out, and mathematically, if you see inflation is a year-on-year number, and if your prices were high last year, unless they become sky high now, mathematically inflation will come down.
Yeah, but sorry to interrupt,
yeah.
but knowing the fact that you have Ukraine war, which is still going on,
Yeah.
do you think this inflation cooling down, I mean, one way of manipulating little bit here and there is okay, but I am saying on a sustainable basis.
Yeah, I don't think that inflation is going up because unless you're telling me that, let's say, crude hit $130 last year, unless we hit 160, we're not going to be in trouble. From that perspective, I'm just giving 130 and 160 as example, but let's say average crude rate versus the average crude rate now. I don't see that being mathematically a big concern. Most companies we speak to are already talking about the raw material pressure being behind them, and therefore maybe some headroom on even reducing prices. And we're seeing that across the board. Of course, any geopolitical event that completely changes the supply side will have an impact, and I'm not saying that isn't a possibility, but as we stand today, it seems business has returned to normal, and yes, there is a tail risk of something like that really changing the scenario, but as of now I don't see it happening. I wouldn't put high probabilities on it.
Okay. Great, Kunal. Thank you so much for your time. It was pleasure speaking with you.
Thanks, Vikas.
Yeah. I hope our investor sitting out there watching this show would also appreciate the fact that you've given a lot of clarity and insights on the table for all of us to really understand and go through. And we hope that equity as an asset class continue to deliver what they've been delivering over a period of last 20 years. Well, if you want to know more about Lapis PMS, the compounder strategy, well, you can visit our website www.aifpms.com and reach out to my team, and they will help you. They will help you with all the data points what you required if you want to make informed decision. If you wish to speak to Kunal, we'll be happy to organize your call with Kunal.
Most certainly.
Thank you.
Thanks, Vikas.